And welcome. Thank you for tuning in to today's webinar on maximizing year-end tax planning. My name is Nancy. I'll be your moderator behind the scenes today. Before we dive into our presentation, I have just a few housekeeping notes. First, everyone is muted to limit disruptions. If you have any questions, you're welcome to share them with us using that questions feature in your GoToWebinar control panel. If we have time during the webinar, we'll answer some of those questions together. If not, we will follow up with you afterwards. This webinar is being recorded. You'll receive a copy of it within 48 hours, along with a copy of the slide deck. At the end of the webinar, you'll be prompted to complete a very short survey. Please take a moment to share your feedback with us. And finally, Saltmarsh's 2023 year-end tax planning highlights are available to download in the handout section of your control panel. With us today, we have Saltmarsh tax experts Suzanne Bach, Stacy Craig, and Brett Snyder. They'll guide you through the upcoming tax law changes and help you game plan your financial strategies for the new year. So at this time, I'll turn it over to Suzanne.
Thanks, Nancy. We're excited to bring you some information today about some fun tax things. So we're quickly going to go through our agenda. Like Nancy said, we're just going to go through some tax updates, and then we're going to walk through, tax planning for year end. What does that look like for you? How do we deal with that with our clients, and what that looks like and how you can prepare. So this is just a little bit of fast facts about Saltmarsh. This slide presentation will come to you just a little bit about our firm and where we come from and what we do. So let's just dive in today with our case study. Oh, actually, we're not diving into the case study yet. We're going to go over some quick updates on the current climate, what's happening in Congress. And so you'll see on here, this slide has got a couple different bullet points. The first section, as of right now, based on the current climate, we do not foresee the first section being passed, but we do want to highlight it and make sure you know about it. And it's something that we are all keeping an eye on. And of course, if you follow us on the socials, we do post about these things. So if something happening, if there is something happening in Congress or something passes, we will push out information to our clients via our social media outlets. So be sure to hit us up on Instagram and LinkedIn and so forth. The second section here on funding, there are still appropriation bills that they are working through. So the IRS may or may not have an effect. If the bills aren't passed, it could shut down from a funding perspective. So February 2nd is kind of that drop dead date for, again, kind of keeping an eye on what's going on. If those bills are going to pass or not, they may or may not be affected. So again, just something to keep an eye out for. I did find out this week is I was thinking when there's a government shutdown, it's like all of the government, but in fact, the IRS can only shut down the IRS. And so there may be an IRS shutdown should these bills not pass. So just again, keep an eye out for that. Just a quick reminder that the filing season for 2023 opens on January 23rd. So I know a lot of you are super anxious to get those tax returns in, as are we, but it does not actually open until the 23rd of January. So just save all of your stuff, make sure you prepare, get everything ready to bring to your CPA. And then when that opens, then we can all start filing. But until then, they are getting ready for this season and prepping. There's software updates, all kinds of good stuff that they're working on. So that is just a little bit later than normal. Just a couple hot topics. Employer retention credit claims. We are still getting a lot of questions about the ERC claims. People that haven't filed, they want to know if they can still file. Where's their money? We're getting still many questions on ERC. And it is a still hot topic that's out there. So as of right now, they are no longer available. But most importantly, the IRS is scrutinizing a lot of the claims filed. So as of this point, there is not money coming back out on those claims. They are really looking at the claims that are in-house, making sure that they're valid claims. If you're aware, there were a lot of startup companies that just came into inception in order to do ERC claims, and they took some very questionable stances on some ERC claims. So they have shut those down for now and are looking into those. So if you've gotten your money, that's great. If you haven't, you may have a little bit of a delay in your time, even if you filed a completely valid ERC claim. And then the final topic here, final item here is the Corporate Transparency Act. And there's a lot of, again, flurry questions, unknowns about this. Right now, there's some special interest groups that are trying to delay the start until 2025. And so really our only comment here is to just stay tuned. There is a lot of information out there, but none of it may be applicable if they delay it. So we don't want to talk about it too much because it may all change or it may be delayed. So again, stay tuned for more information from us coming out about that. So now we're going to dive in to our topic at hand here today. So we're going to walk through a tax planning scenario for Mr. Burns. If you're familiar with the show, then you will find this amusing. If not, you're going to have to go back and watch some YouTube videos and get up to speed on some of our humor because it will go right over your head. So we're going to look at Mr. Burns. Here's some quick facts about him. Right now, he is the owner of Springfield Nuclear Power Plant. He has some relatives, but his legal heir to his throne of his power plant and related things is Bart Simpson. He went to Yale. He was in the Army. He is a billionaire. So he has a lot going on from a financial perspective, and we'll dive into that a little bit later. His current investments, as you can see, are some obsolete companies. He's got some land throughout the country, and of course, his interest in his current power plant. And so in case you're wondering if we made this information up, we did not. Our sleuths went sleuthing on the interwebs, and we found all of this information on Wikipedia. So these are facts, guys. These are true facts, as it is per.
True facts about a fictional character.
Yeah, it's too soon. I'm sorry, guys. I forgot. I kept rolling. So we're going to call Mr. Burns and give him a call. And if you guys missed the audio, we just called Mr. Burns and he answered the phone, but that was my bad. So a lot of people ask me, what are we talking about at our meeting with our CPA? You know, we don't know how to prepare. We don't know how to be ready. You know, what should I come prepared to talk about? And so here's some sample questions that we are going to talk about with Mr. Burns today. You know, how is the business work, you know, doing? Are they inclined to give to charities? Does he have a will? Does he have an estate plan? You know, what are some of his long-term goals, whether they be personal or for business? And so all of these things are really important when we're looking into tax strategies and projections and planning for any client. And so here are some of the questions. And it looks like, let's see, he is charitably inclined. As we know very well, he's not aging, so he's never going to die. So he's probably thinking he really doesn't have to worry about an estate plan, but we will convince him otherwise today in our meeting. So we are going to start our meeting with a quick discussion about what can he do, what planning opportunities are available for Springfield Nuclear Power Plant. So I'm going to pass that over to Stacy and have her talk about what we can consider.
Thanks, Suzanne. So in talking with Mr. Burns, we know that he wants to do some expansion. So typically when you have a situation like that, you're buying furniture, you're buying some machinery, you're buying some equipment, some computers and things. And under regular IRS rules, you typically have to take that cost over several years. So that's what we call depreciation. Bonus depreciation allows you to take that deduction more upfront in that first year rather than having to spread it across. Now, starting in 2023, the amount that you're allowed to deduct in that first year is limited to 80% of the cost, with the remaining being written off over the tax life. However, from 2024 to 2027, that percentage is going to keep going down until it's completely eliminated in 2027. So another option that we have is what we call Section 179 expensing. And so Section 179 expensing will typically cover those same types of assets that we just talked about, which are to think of it as like non-structural components within your building and your business. Section 179 expensing does have a maximum amount that can be deducted each year and a spending cap, so that expense is phased out. The allowable deduction is phased out if your total purchases exceed the maximum set by the IRS that we've listed out here. So another item that we see a lot of businesses reinvesting in is their vehicles, their automobiles. So we want to talk a little bit about how bonus and depreciation 179 are impacted through autos. And this falls underneath what the IRS calls the luxury auto limits. And so the first thing we need to do is explain what a luxury auto is, because I know for me, I need a little bit of time travel involved in my luxury auto. Brett and Suzanne, they're just about the speed. But the IRS says it's about 4 wheels. If you have 4 wheels on the road, you've got a luxury auto. So what they've done is they've broken out different classes of automobiles. Those under 6,000 pounds have the most stringent limits. Those between 6,000 and 14,000 pounds, your SUVs, your light trucks, your vans have a moderate limit. And then there's no limit over 14,000 pounds. And so when we talk about Section 179 and bonus, it sounds very similar. And so we just wanted to kind of go over some of the questions that we see, things that we look at from the CPA's perspective. And you might be wondering, why are they asking me these questions? Well, we're trying to get you the best deduction here. So for example, if you have assets that you are putting in service for a rental activity, those assets are not going to qualify for the Section 179 deduction, but they will qualify for bonus. As well, if you purchase that item from a related party, we cannot use Section 179, but we can use bonus. Another item that we come across a lot is that we need to understand what your business use is going to be, not only in the initial year of purchase, but how you plan to use that asset in future years. Because if that business use falls below 50%, then there may be some recapture if we use Section 179, where it's not if we use bonus. Another item that has recently come into play under the TCJA rules is talking about structural components and are they qualified real property. So the IRS has allowed that you can take Section 179 on, for example, a commercial HVAC system that was installed on the exterior of a building, or if you have a roof that is installed on a non-residential building, we can take Section 179 for that. However, for bonus depreciation, it's disallowed because the life is still over that 20-year limit set. And then lastly, a question that we get a lot is, what about losses? Can this deduction create a loss for my business so that I can offset activity in another part of my tax return? And the answer is, for Section 179 purposes, you cannot generate a loss. So any excess Section 179 over the income of the business is carried forward to the next year. However, for bonus depreciation purposes, you are allowed to have bonus expense in excess of what your income is.
So do you think one is better than the other? I get that question a lot.
So I think this is where it's really important for us to understand what it is that you're going to be using that asset for, and kind of taking all of these items into consideration, because we want to understand what is the outlook of your business. We want to understand what states are you operating in, because the states also have different rules between Section 179 and bonus depreciation. So if we can understand exactly what type of asset it is that you're purchasing, what type of activity you're purchasing it in, and then what type of use and future outlook you have for your business, then we can kind of determine which one is the best one to use to get you the maximum deduction today.
Yeah, because that's something that comes up a lot. Some of the states don't recognize them the same, so you can have a difference between your taxable income for the federal and taxable income for the state. And so that is definitely something that is brought up a lot. I would say, 179 is a huge area. I definitely get one of the most questions, I would say, about Section 179 versus bonus, and how do I take it? Which one is better? Things like that. So a question I get a lot too is, what if Mr. Burns doesn't have any cash? What if he is cash poor at the end of the year, but he wants to take advantage of these deductions?
Right, exactly. So you can definitely take out a loan. You can use other sources in order to purchase that equipment. It does not have to be a cash purchase, but we're really great components of saying, like, don't spend money just to save tax. You need to review your capital budgets, review your forecast for your business, and look at what your business needs are and build that purchase around the needs, not just the ability to get a deduction. In addition, we also see that there are some people that have different types of machinery and things that might have a production period greater than 1 year. There are special rules related to those types of assets as well, where you can enter into a contract in 23 in order to get greater bonus in 2024, but that might not be placed in service until 2024. So if you have one of those long production assets, that's something
That would
else.
be like if you're a manufacturer and you're building a new line to build your product, that would be considered a long production asset.
Right. So example, yeah, exactly. We've seen a lot of the automation equipment is very specialized equipment that will usually take a very long period of time in order to implement and get placed in service. And that's one of those things that we would want to find out about. So it's more of a future thing of what is it that you're doing, and is there something that we can do today to help save you money tomorrow? And then we always talk about automobiles and say, you know, when you're considering a new automobile, check with us, tell us about what the make, the model is, what type of chassis it's built on. There are some auto companies that are getting very smart, and they might have a crossover vehicle, but it's actually built on a SUV chassis, which allows you to get greater depreciation. So it's all of these small little things that you might be asking, why does my CPA care about the chassis on my car? We're just trying to help save you money.
So pretty much the IRS has driven the scope of vehicle production is what I'm getting from this. So if you're wondering what drives new cars and why Ford is making some new cars, probably having to do with some Section 179 deduction. So Mr. Burns is kind of telling us, hey, I don't have a lot of equipment I need to buy. I don't have any automobiles that I need to buy. Are there any other opportunities that Mr. Burns could take advantage of for the upcoming year or for this past year?
Absolutely. So one of the other things that we've seen that Congress has implemented a lot of adjustments to the energy credits, which I know you're thinking, Mr. Burns in a nuclear power plant, like that doesn't make any sense. But he really does have a kind heart, and he's trying to get better at being green. That's what we found out through our conversation. And so what we've seen here is that for individuals, we still have what we call the solar energy credit, which is a declining percentage based off of the installation cost of those solar panels. But there's also a credit for energy efficient residential improvements, which are like your windows, your doors, your insulation, and they've been more generous this year than what they have in years past. And also for businesses, there is a energy efficient commercial deduction as well. And so we've included a link in the slide deck that we'll be able to send out to you to have more information if your business is wanting to get more green. In addition to the buildings, there's also the energy credits related to automobiles as well. So this has also seen a revamp over the past couple of years, and that the electric vehicle credit is now referred to as the new clean vehicle credit. However, they have implemented additional limitations on taking this credit. So there are MSRP limitations as well as income limitations. This credit is available for individuals. It's also available for businesses. For those businesses that want to get around that MSRP or income limitation, there is a qualified depreciable commercial clean vehicle credit, which is very similar. However, you do need to look at that vehicle's incremental cost. So they are doing some things to try to make it more affordable, but the result of all of this is basically to say, if having a tax credit is a major factor in your decision-making process, reach out to your CPA, because the tax impact is going to vary greatly depending on your tax situation. It's unique to everyone. So if you're considering something, reach out to us and we can help you get a better grasp on what that impact will actually be.
Yeah, because I don't know about you, when the last two slides went by, there's a lot of information there. And like Stacy said, we ask a lot of questions and we're trying to get you some answers based on all those crazy questions, like what's your vehicle weight? people look at us crazy when we ask things like that. So what if, so Mr. Burns, we talked about at the beginning, when we were asking him questions about his current situation, he says, hey, I'm thinking of possibly making some investments in real estate, or I'm looking at buying some real estate or selling some real estate. Are there what can you tell Mr. Burns about real estate?
Right, absolutely. So, we saw from his investments, they're a little bit stale, but he does like some real estate. So if he's looking to sell some of that real estate, chances are he probably bought it in the early 1900s, and now it's got some pretty significant gains in it. So one of the areas that we see is still a viable option for a lot of taxpayers is a qualified opportunity zone fund. So in these types of funds, you take the gain from the sale of a capital asset, and then you reinvest those gains into a qualified opportunity zone fund. That fund invests in businesses in underserved communities. So we have here a picture of Florida, and the areas highlighted in blue are the qualified opportunity zone funds. The benefit to Mr. Burns for this is that he does get some tax deferral, and that he does not have to pay tax on the gain of his original sale of land until 2026. And then the qualified opportunity fund can continue to grow tax-free, and the subsequent gain on the sale of that qualified opportunity fund is excluded from tax.
So you joked about his real estate, how he bought it probably in the 1930s or something, but this is a real thing, because if you even had real estate in 2019, it has gone up considerably in the last 4 to 5 years. And so this is definitely an area, if you're looking to expand your business, your footprint, get into new areas. The blue shaded areas are the areas that you'll want to take a look at, because those are the opportunity zones. Now, is there I kind of had a question on this. It's rolling through my head anyway. So if there's nothing available, or if you don't have any property to sell, how does that work? Like if you don't have another piece of property to sell, does that matter? Does it roll like a 1031, or how does that work?
Right. So one of the benefits of the qualified opportunity zone fund is that if you have gains from stocks and bonds that you've held, those are qualifying gains to be reinvested in a fund. If you don't have a property that you want to purchase, if you don't want to create your own opportunity zone fund, there are funds out there that you can invest into. So it's not something that you have to do on your own. This is highly regulated. The testing and the details on this are very specific. So you do want to be involved with a tax advisor that has thorough knowledge of these funds. Another benefit of a qualified opportunity zone fund over a 1031 is that you only need to reinvest the gains. And a 1031, you need to reinvest all of the proceeds. So whatever your sales price is, that's what you need to reinvest in order to have gain deferral. And the qualified opportunity zone fund, you're only reinvesting that gain. So for example, if you have a highly leveraged piece of land where you're paying off a mortgage when you sell it, but you're still selling it at a gain, you can take gain proceeds and invest, rather than the 1031 where you would have to figure out that mortgage piece in order to not have that tax hit for you.
Perfect, thank you. So now we've gone over some of the business strategies for Mr. Burns. So now we want to make sure that he's personally secure for the the next stage of his life. So we're gonna go to Brett to start talking about some of his opportunities here.
Thank you, Suzanne. And before we really dive into the next stage of Mr. Burns's life, I did want to take one moment briefly to remind everybody that if you have an inherited IRA that you were inherited after January 1st of 2020 as a non-spousal beneficiary, that everything must be withdrawn from that by the 10th year after the original owner's death. So this means that the IRA can no longer be stretched out over the beneficiary's life expectancy. So with that little bit of housekeeping out of the way, we are back on with the show. And as Mr. Burns enters the next phase of his life, retirement account planning becomes increasingly important. To navigate through the complexities of financial stability in his retirement years, it's essential to explore some different strategies. which might be a Roth IRA conversion or a backdoor Roth IRA conversion, and qualified charitable distributions from an IRA. A Roth IRA is an individual retirement account that lets you contribute after-tax dollars, then enjoy tax-free growth and withdrawals. Once you hit age 59 and a half and have held the IRA for at least 5 years, you can take distributions of your contributions and investment earnings without paying federal taxes. Unlike a traditional IRA, there are no required minimum distribution amounts that a Roth IRA account holder must take during their lifetime. The main difference between a Roth and a traditional IRA is how they're taxed. A Roth IRA gives you tax-free withdrawals in retirement, while traditional IRAs give you a tax break when you contribute. So if you want an immediate tax break, consider using a traditional IRA. If you like the idea of tax-free income in retirement, Roth IRAs might be a better option for you.
Is Mr. Burns eligible for any of those?
Well, that's the beauty of doing a Roth IRA conversion or a backdoor Roth conversion. So for individuals with high incomes who can't normally contribute directly to a Roth IRA, a Roth IRA conversion allows them to take advantage of the tax benefits. A Roth IRA conversion involves moving assets from a traditional IRA or an employer-sponsored retirement plan like a 401k into a Roth. Similarly, a backdoor Roth IRA conversion involves contributing to a traditional IRA and then turning around and converting that to a Roth IRA. Keep in mind that either conversion will require paying taxes on the converted amount. However, with a straight Roth conversion, where you've held funds in a traditional IRA, the taxes may be higher depending on how long those funds to be converted have sat in the traditional Roth IRA and how much they've grown. Because a backdoor Roth can be done in rapid succession, meaning you can contribute into a traditional and then turn around and convert it to a Roth, there's less time for gains to accrue that would incur tax upon the conversion. Some of the benefits of doing
a lot of questions about the types of IRAs, whether they want to do this or that. And there's just, even just everything that you just said, it seems like there's a lot of options, right?
Yeah.
So if you don't know if you qualify or if you have questions about which one is the right one, there are a lot of options. So make sure to get with your, tax advisor or us, to help you navigate through that, because I know even that I know about it, and it's still, I feel like I learn something new every time, like Brett and I, get together, because there's some rule that maybe we didn't know about. So just keep in mind, if any of that is confusing to you, we understand, and we can help you kind of navigate through that.
And the rules seem to be changing all the time. So some of the benefits, though, of doing a Roth IRA conversion is that it, allows people who otherwise wouldn't be eligible to access a Roth IRA. And you have the potential for the tax-free growth and the tax-free withdrawals. Unlike a traditional IRA, there are no mandatory withdrawals during the account holder's lifetime. But there's also some key considerations that you need to think about, such as if you're in a high federal tax bracket today, but you expect your tax rate to be lower in retirement or in the future, maybe doing a Roth conversion may not make the most sense for you. Try to think about the timing of the conversion so you can optimize the tax efficiency. Because the tax will be paid on the assets converted from a traditional to a Roth, timing the conversion to fall in a year where your taxable income is lower than other years will create less of a tax hit than it otherwise might. You also have to remember the pro rata rule, which impacting tax liabilities during conversions. What this means is that since a backdoor Roth conversion involves withdrawing traditional IRA funds and transferring them to a Roth IRA, the pro rata rule applies. So if you have never contributed after-tax money to a traditional IRA, the total amount you convert to a Roth will be taxed at your normal income tax rate. The process is relatively straightforward. However, if your traditional IRA contains both pre-tax or deductible and after-tax non-deductible contributions, the pro rata rule dictates that your Roth conversion will be taxed proportionate to your pre and post-tax percentages. This prevents people from skirting the Roth income limits and manipulating funds to lower their tax bill. And you are not allowed to choose which funds you convert. Like Suzanne just mentioned, this means consulting with your financial advisor and your tax advisors when doing a conversion is so important. Another thing that Mr. Burns could look at doing is a qualified charitable distribution from a traditional
I have
IRA.
a question about that. I mean, he's like a bazillionaire, right? So is he philanthropic? I mean, do we know that about him? I think we asked him that in the beginning, and he said he likes to give to Yale, but you know, is that, you know, I guess, yeah, does that count?
Well, while Mr. Burns may have a reputation for being cold-hearted, it's amazing how even the coldest people can become charitable when they see the tax savings that they can garner from it. And so a qualified charitable distribution is something that's for individuals age 70 and a half or older, where they can directly transfer up to $100,000 per year from their IRA to eligible charities. And this amount will count towards their required minimum distribution, and it's excluded from their taxable income. Things to consider when doing a qualified charitable distribution is make sure your charity is eligible and meets the IRS requirements. So if Mr. Burns wanted to make a contribution to Yale, it would be okay because it's a qualified educational institute.
If you are a complete Simpsons nerd, you will know that in episode 19, season 34, that Marge started an organization to help the displaced people of Springfield. And so what you're saying is he would have needed to make sure that Marge's organization was on the up and up and followed all the rules for the 501c3 before giving to her charity.
Exactly. He would want to make sure that she's filed all the necessary paperwork to be recognized as a 501c3 entity.
That's, yeah, really important. You may think you're giving to a charity and trust Marge, you know, but she perhaps didn't follow all the rules, and then you could possibly be declined that deduction then if it was not an eligible charity. So something you definitely want to pay attention to.
I think it's also just important to note that there are some items that are deductible as a charity on Schedule A, like a private foundation donation or a donation to a donor advised funds that aren't allowed for the qualified charitable distribution. So even there, they've gotten a little bit more specific about which donations qualify.
That's right. And in line with that, you want to make sure that you keep any sort of proper documentation so you can adhere to the IRS guidelines for the qualified charitable distribution. And also think about integrating the integration of your qualified charitable distribution from your IRA into your overall charitable giving and retirement planning strategies. There's several benefits also to a qualified charitable distribution. Besides fulfilling your charitable goals, it will reduce your taxable income. And this is especially helpful for people who may not otherwise be able to itemize their deductions. It still allows them to support the causes that are important to them while enjoying a tax benefit. Proper retirement account planning and exploring whether these strategies may help you play a critical role in securing a comfortable and financially stable future. Next, we're going to talk to Mr. Burns about estate and succession planning.
Right now, he's giving everything to Bart. Everything to Bart right now. That's his main heir. Is giving? Is that how it would work then? You know, if he passed away,
we'd have to take a look at his will, and that's kind of brings us to our first point. You know, you may think that estate planning is just for the wealthy, like Mr. Burns, but estate planning is a strategic way to ensure your assets are managed and distributed according to your wishes, regardless of the size of your assets. Thus, estate planning starts with having a last will and testament. That's the one thing everyone should have, regardless of the amount of wealth that they have. The consequences of dying without a will, or what is referred to as a dying intestate, is that your estate plan will be determined by your state statutes. The singer Prince is a prime example of the problems that can arise. When Prince died suddenly in 2016, he left an estate estimated to be worth over $150 million and no will. And after a 6-year court battle that included a federal inmate claiming to be Prince's long-lost son, a Minnesota judge was finally able to determine Prince's heirs in 2022. Had Prince left a will? many of these challenges would have been settled quicker and easier. It also
Like
cost
Prince,
you
the
millions.
like the August Prince, you know, didn't have a will.
Nope. No,
Wow.
they did not.
And Aretha Franklin had a will, but it was stuffed in her couch. So you need to make sure that you make the will and then put it in a secure place.
Yes.
It was stuffed in her couch. Wow. How, I guess they found it while cleaning out her couch. That's insane.
And seeing the difficulty
So
they
does
had
it matter
locating
if
it, I would say that finding it in the couch cushion may have been a good place for it.
It may have been a better place than none. So what if you don't have kids? I get that question a lot. Like if somebody doesn't have kids, they think, well, it's no big deal. I don't have kids. I don't have to worry about a will.
That's not true, because you still want to have control over where your assets go after you die. You know, if there may be a relative that the state statute would say would be next to inherit your assets, and what if you're not a big fan of them? You don't get along with them, and you'd rather have your assets go to a charity that means something to you. Having a will enable you, will allow you to know that that's what's going to happen after you pass away. But executing a will is even more important, though, if you have minor children, because the guardianship rules can vary by state and they can be quite expensive. In addition to having a will, Mr. Burns wanted to look at transitioning his business to the next generation, and this requires careful consideration. It involves not only transferring ownership, but also preparing the successors to handle the responsibilities of business ownership effectively. Selling a business can be a part of your estate plan. When selling, it's essential to evaluate the optimal time to sell, the potential tax implications, and the impact on your overall financial plan. Gifting your business during your lifetime can also be an effective strategy. However, it's crucial to plan this carefully, considering factors like the value of the business, the potential tax consequences, and the impact on your own financial security. If your business was your biggest asset and now you're gifting it and you're not getting anything in return, how are you going to survive during retirement with nothing else? Providing gifts to minors can also be a safe way to transfer wealth and assets. This can be done by setting up trusts or custodial accounts that can ensure the minors receive the assets responsibly and at the appropriate times. There are some things to consider when looking at your succession planning. Be sure to consult with your legal and your financial advisors. This ensures that your estate plan aligns with current laws and your specific circumstances. Be sure to review your estate plan regularly and make updates to it. Life changes, so should your estate plan. And this would include making sure your beneficiaries are updated on your retirement account and other assets, as well as keeping your estate planning documents updated. And then communication. You need to discuss your intentions with your family and your next of kin, and this can minimize potential conflicts.
So the estate plan is not a set it and forget it.
Exactly. It is a set it and remember it sort of thing.
Exactly. So this is something I would say in recent years that has been a very hot topic of clients, you know, asking about selling or valuing their business for a sale. There's a lot of private equity money running around. And so there are a lot of strategies that go into this. You can't just wake up one morning and really truly just sell your business without any kind of planning. So it's something I think people do think that, though. They'll just wake up one day and sell their business and everything will be hunky-dory. But some of these plans can take, you know, months and years, depending on your situation, to put in play and to put into motion for the best, again, for the best tax strategy or tax savings or just long-term planning that you're hoping to get from your estate or from your business. And so get in front of it is really a huge piece of advice coming from us, is don't wait until the last second. Nobody wants to talk about these things, but it's very important that you do and get in front of it so that you do take the best strategy, and you sit down with your, you know, circle of trust, your attorneys and your accountants, and make sure that you're planning to get the best situation in the end.
Yeah, Suzanne, you're exactly right. I mean, one thing that I know that I'll tell my clients is that regardless of the size of your estate, you need to be proactive and planning, because when you're proactive in your planning, that's the key to preserving your legacy and making sure that
Preserving is the word I was looking for. I said preserving is the word I was looking for.
Exactly.
Yeah. Yeah.
So
Go ahead, Brett.
So there are some planning opportunities though, some estate planning opportunities right now. Under the Tax Cuts and Jobs Act that Stacy referenced earlier, there are some remarkable estate planning opportunities available due to the increased lifetime exemption it provides until the end of 2025. The Tax Cuts and Jobs Act was enacted in 2017, and it significantly increased the federal estate tax exemption. As of this year, the exemption stands at almost $13 million per person. So this allows individuals to transfer up to this amount free of federal estate taxes. And keep in mind that if the federal estate tax is something that's different than your normal income tax. This is an asset-based tax. It's a transfer. It's a tax on the value of your assets that are transferring upon death or during your lifetime. However, at the end of 2025, this exemption will roll back to an amount that's estimated to be between $6 and $6.5 million. Given that this increased exemption is set to revert to previous levels by 2026, it's crucial to capitalize on this window of opportunity. Here are some different ways that you can do that. You can maximize your gifting strategies. You can do this by leveraging the current exemption. Individuals can strategically gift substantial assets to their heirs or into trust structures, which effectively remove these assets from their taxable estate. You can also utilize exotic estate planning vehicles like grantor retained annuity trusts and intentionally defective grantor trust. These sophisticated tools allow individuals to transfer assets to beneficiaries while minimizing the impact of potential estate taxes. Establishing a family limited partnership or a limited liability company is another method. By creating these entities, it allows somebody to transfer wealth efficiently and allow for centralized management of family assets while taking advantage of valuation discounts. And this kind of goes back to what Suzanne was just talking about with planning and making sure that you have values and not waiting till the last minute. All these sorts of things take time to put together and to structure and to value accurately.
So is the gift tax exclusion going down also along with the lifetime exclusion?
So you have your annual gift tax exclusion amount. That's an amount that you can give each year to as many individuals as you would like, and that will not impact your overall lifetime exemption amount, that almost $13 million number as of this year. So Suzanne, if you were feeling very charitable this holiday season, you could write as many $17,000 checks to as many people as you want, and it would not impact your lifetime exemption. However, if you wrote one check incorrectly for $17,001, that $1 over $17,000 would decrease your lifetime exemption amount by that $1.
Okay. So overall, I think what we're wanting to get across here is that if your estate is estimated at over $14 million, you want to make sure to get in front of your CPA before the end of 2025 because
Absolutely.
It's going to go down.
Absolutely. Estate planning in context of these exemptions, it really requires a tailored strategy that aligns with the individual's financial goals and their family dynamics. So seeking advice from experienced estate planning attorneys, tax professionals, financial advisors becomes paramount to navigate these opportunities effectively. But keep in mind,
didn't mention it earlier. I always like to tease attorneys, but Brett is one of those attorneys. If you noticed all of his credentials here at the beginning of our slides. So it is not always common that a CPA has a state and wealth attorney on staff or on our team. So we have Brett. And so just so you guys know, plug for Saltmarsh that we have that internally here, and Brett can help you with all of your estate planning needs. So everything we're talking about.
That's right.
And I'd just also like to add in there that a lot of times the accountants, the CPAs will read very differently a document than an attorney. And then the client may have a completely different expectation of how this is going to roll out. So it really takes that community of people coming together to really understand and implement what it is that the client actually wants to see happen.
There can be a lot of confusion in exactly that. The client thinks it's one thing, the CPA thinks it's something else, and the attorney's like, no, it actually says this. Here, I redlined it.
One other thing I like to add, though, what I like to tell clients is that, yes, while taxes do play a role when you're doing your estate planning, you have to remember that estate planning is ultimately an economic decision, and you shouldn't let the tax tail wag the dog. And that means that you need to make sure that your plan meets your goals first and foremost. We can figure out any sort of tax savings and tax strategies underneath that. But if your plan and your goals aren't being met, that's the first thing that needs to be addressed. Your plan needs to change so that your goals are being met first.
For sure. So we talked about in the beginning, we're going to show you a estate tax, before and after planning, because a lot of people, they aren't quite sure what it looks like. They're, really, do I want to jump through all these hoops? Do I want to spend all this money? Do I want to do all these things? How is it really going to affect us? So I know internally here at Saltmarsh, Brett has a software that he uses to do these projections, obviously. And so that's why we ask all the questions, we have the meetings, and then we're able to provide our clients with, here's how it will actually look under various scenarios, so that you can, then make a determination of what works best for you and fits your long-term plan that, Brett just talked about. So here's our before.
So on this slide, you're seeing what Mr. Burns' estate tax liability might look like if he did no planning other than executing a simple will. For these purposes, we assume that he died in 2026, meaning that the estate tax exemption has been rolled back to about $6.8 million. And so when we do this, we see that he would owe over $500 million in estate tax. And that's before any sort of generation skipping transfer taxes are added to it if he were making his sole heir, Bart Simpson, who would likely qualify as a skip person. So you could almost double that amount of tax when you add in the generation skipping transfer tax to it. However, if we do some simple estate planning with Mr. Burns, we're able to lower his liability by a decent amount. We do this by assuming that we're able to save his heirs almost $100 million in estate tax. In this example, Mr. Burns funded an irrevocable trust in 2023 with a lifetime exemption amount of almost $14 million. That removed $14 million from his estate. He also made a testamentary charitable contribution of $200 million to his alma mater, Yale, to fund the Montgomery J. Burns School of Nuclear Power. Now, if Mr. Burns had taken advantage of making annual exclusion gifts like Suzanne is this year, and of $17,000 in 2023, and then $18,000 in 2024, and again in 2025, and again in 2026 before he died, he could have lowered his estate tax even more. That it's also important to remember that these strategies can be very important for people with estates in the $7 million plus range. As the lifetime exemption is rolled back at the end of 2025, taking advantage of these strategies now can save the taxpayer's heirs millions in estate tax upon their death. So just because your estate may not be quite as large as Mr. Burns's doesn't mean that this stuff can't help you.
All right. So we're about 3:19. We're doing very good on time. That's Eastern time for those of you in other time zones. We just have a slide with some random stuff because every year we have just reminders that we feel like should go out in some sort of booklet or a letter, but we're going to give it to you guys instead. So just again, reminders, S Corp owners, make sure that your health insurance is added to your W-2. If you use a payroll provider, you need to get with them. They're not going to reach out to you. They're not going to ask you, what is this number? You need to get with them and you need to tell them, this is my health insurance amount. I need it in my W-2. And so this is if you're an owner of an S Corp. So if you are one of those people right now, or if you work for one of those people, make sure that you get this number on their W-2, because we've had the case where we've had to redo W-2s, get with payroll providers to redo W-2s, and it's messy and expensive. So just if you can do that earlier than later, that would be great. Use your FSA funds. They don't roll if you have an FSA plan. So make sure you've got, 10, 11, 12 days to do that. Make sure you do that. Make sure that your checks for charitable giving are in the mail by 12/31. And so that does matter that the donation is made. If you're doing it on a credit card, if you're doing it any which way, it needs to be done before year end. So just a reminder to get all of that done before before 1/1. If you guys use a PIN, which most of you should, if you aren't, please make sure you do get one. Be on the lookout for the letter. I'm a huge guilty person here of losing the letter. Okay, so if you get the letter, save it in a secure spot. Hopefully you've got a safe or something like that. Don't take a picture of it, because then that number is now on your telephone. And if someone hacks into your telephone, they now have access to not only whatever's in your telephone, but also a photo of your PIN number. So I know a lot of people are like, oh, I take a picture of it so I don't forget it. That is not a good idea. So make sure to put that somewhere safe. Again, totally guilty, lose the letter at least 1 out of 3 years. Here is a website also, just in case you have any. There is a lot of identity fraud with tax returns. People will file tax returns under your name, using even fake social security numbers, but just it's very common. It happens a lot. All they need is a couple things from you to file a tax return and get a refund in your name. And then when you go to file, they tell you it's already been filed. And so if you go out here and check out some of the scams, try to avoid them. That's a big risk right now. Then also this, yeah, Stacy, go ahead.
The IRS said this year they are going to try out for a handful of people. Instead of getting the letter, they're going to use those security envelopes that I don't know how everybody else is, but I can't ever figure out how to open it. I end up ripping it, and then I can't have to tape the pen together. So just be on the lookout that it might be in a little bit different format this year, that, we'll still take it if you tape it together and send it to us, but we still need that number. So just be aware, it might be look a little different this year in January.
Envelopes. There's instructions too. I'm a smart person. I don't know why I can't follow them.
Yeah. The one time I don't read instructions, I give up.
It inevitably looks like a gerbil, got a hold of it or something, some kind of rat, because I'm like, anyway, I can't be the only one that does this. But then Stacy, why don't you tell us about the FAFSA?
Right. So for our clients that have kids that are in college, that this time of year you're talking about the FAFSA form, and that's where you have to tell your college every single thing that you've ever done your entire life, and how much money you've made. And so one of the things that has happened recently with 529 plans, so that is the plan where you can contribute and then you can use that money later on when the child is in college for eligible college expenses. If those 529 plans are owned by the grandparents, they are no longer going to count towards the student's FAFSA eligibility. So in the past, those account balances used to be added in as part of the student's contribution towards their education, which could drastically cut financial aid that was offered to that student. So now they're saying you don't need to include that balance, and therefore for those that may receive some financial aid with the astronomical cost of college now, this is kind of a help to say, like, hey, grandparents, if you want to own this, then that's going to help on our students' FAFSA eligibility.
Awesome. So those were kind of our hot, just again, random stuff that we at year end always come up for us. So we want to thank you guys for coming today. We hope it's been interesting for you and we've been able to make tax updates a little enjoyable, a little entertaining for you. I know Nancy's going to hop back on and give you some closing arguments. And Nancy, here you are, so I'll pass it over to you.
All right, well, thank you guys so much. And thank you, audience, for joining us today. As mentioned before, today's webinar was recorded and you will receive a link to that recording sometime tomorrow. Be sure to check your spam or junk folders because sometimes those emails land in there because of the security filters. Feel free to contact Suzanne, Stacy, or Brett, or any member of our tax team if you have any questions at all. They'll be more than happy to help. And remember, after this webinar, a survey will pop up on your screen. Please leave some feedback for us. We would love to know what you thought about our webinar today. But with that, thank you all for joining us and happy holidays.
Thank you.
Oh.